Right now, somewhere in North America, a data center is drawing more electricity than a mid-sized city. Not a metaphor, not a projection, happening right now. And the grid powering it was designed in 1978. Here's what that means for you, not as a citizen, not as a consumer, but as someone who controls capital and decides where it lives. The single greatest structural vulnerability in the global economy right now is not inflation, it's not geopolitical conflict, it's not even debt. It's the gap between how much power the modern world demands and how much the centralized grid can reliably deliver. And that gap is widening every single quarter. If you've been positioning your wealth around financial instruments, equities, bonds, digital assets, and you haven't asked yourself what happens when the infrastructure those instruments depend on starts to buckle, then you are not building wealth. You are renting exposure to a system that was never designed to carry this load. We don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom. Welcome to Wealth Forge. I'm Dr. Ben, and today we're going to talk about the asset class that doesn't show up in most institutional portfolios, the one that doesn't care whether the Fed raises rates, whether crypto corrects, or whether the S&P spends another year going sideways. We're talking about localized energy production. We're talking about what I call energy hegemony. And by the time this is over, you'll understand exactly why controlling your own power supply is not just a strategic advantage. It's the foundational layer of every other form of wealth you intend to build. Stay with me through all 5 sections today, because the fourth one, on specific asset allocation models and the regulatory window that's closing right now, is where the actionable framework lives. Everything before it is the context that makes that framework make sense. Let's get into it. The fracturing global grid is not a problem that crept up on us quietly. The signals have been flashing for years, but 2025 was the year those signals became undeniable. Here's the number that changed everything. AI compute demand globally surged past 200 gigawatts of continuous draw in 2025, and that figure is growing at roughly 40% annually. To put that in perspective, 200 gigawatts is approximately the total electricity generation capacity of the United Kingdom. We added the equivalent of an entire nation's power demand, and we did it in less than 18 months. The grid didn't expand to meet it. The grid hasn't expanded meaningfully in decades. In the United States, the average age of a substation transformer is over 40 years. In Europe, many of the foundational transmission lines date to the 1960s. These systems were built for a world that ran on household appliances and office lighting. They were not built for hyperscale AI training clusters, drawing continuous industrial-level loads in concentrated geographic zones. What does that produce in practice? It produces brownouts, rolling outages, load-shedding events, which is the utility sector's polished way of saying the grid gave out and we cut your power so we could protect higher priority nodes. And these are no longer rare. Texas has experienced 4 major grid stress events in the last 2 years. California issues flex alerts routinely. Phoenix saw rolling outages during its 2025 summer heat waves that lasted longer than the utility initially admitted publicly. And here's what makes this a wealth conversation rather than just a policy conversation. Traditional financial hedges are powerless against this failure mode. Gold is a store of value, but it doesn't run on its own. You still need power to operate the exchange, run the vault security systems, execute the trade. Crypto carries the same dependency. The blockchain doesn't care about your conviction if the nodes go dark. The S&P 500 is a portfolio of companies that every single one of them requires continuous, reliable electricity to function. Every single one. When the structural layer fails, the assets sitting on top of it fail with it. This is the insight that changes how you think about portfolio construction. The question is no longer just what appreciates. The question becomes what survives. And to answer that question properly, you have to understand what I mean by energy hegemony. Energy hegemony is not a theory, it's not a buzzword, it's a structural condition, and it describes the emerging reality where the entity that controls localized power generation controls the economy around it. Let me draw this clearly. For the last century, energy was treated as a utility. You paid a monthly bill. Power came from somewhere distant, a dam, a nuclear plant, a coal facility hundreds of miles away, traveled through transmission lines, through substations, through local distribution networks, and arrived at your property. You had no control over it. You had no ownership of it. You were entirely dependent on the chain holding together at every single link. And for most of the 20th century, that chain held well enough that no one questioned the dependency. That era is ending. The shift we're watching unfold in real time is the decentralization of power generation. Solar costs have declined by over 90% in the last decade. Commercial-scale battery storage has reached economic viability for the first time in history. Microturbines, biogas generators, small modular reactors at the community scale, these are not future technologies. They're deployable today. And the entities moving fastest to deploy them are not utilities. They're private operators, real estate developers, industrial facility owners, tech campuses, and increasingly high-net-worth individuals who understand what controlling their own power supply actually means. Here is the shift in plain language. In the old world, energy was a bill you paid. In the new world, energy is a moat you own. Let me stay on that for a second because I think that single sentence is worth holding before we move forward. Every framework on this channel, every concept we've built out around generational wealth, around asset protection, around financial sovereignty, comes back to one question. What do you own that keeps working for you when external conditions deteriorate? That is the moat. And energy, localized, controlled, owned energy is rapidly becoming the most foundational version of that answer. Think about what a moat does. A moat doesn't generate revenue by itself. It creates a protected interior where your real activities can continue regardless of what's happening outside the wall. If you own the power supply to your properties, your operations, your data infrastructure, you have built a moat that every competitor, every tenant, every counterparty without that capability now has to navigate around. You become the island of stability in a sea of unreliable dependency. And this matters at every scale. I'm not talking exclusively about utility-scale projects. I'm talking about the residential solar array and battery system that allows a $4 million property to maintain full function during a regional outage and transforms from a liability during a blackout into the most valuable structure on the block.
I'm talking about the 50-unit multifamily development with islanded microgrid infrastructure that commands a 15% rent premium because tenants have experienced what the alternative looks like. I'm talking about the private industrial facility that is fully decoupled from the municipal grid and now sells excess capacity back to that grid at premium rates during peak demand events. The structure is the same at every level. You move from consumer to producer, from dependent to sovereign, from following the market to designing the moat. Now, I want to acknowledge something here because I get this question a lot from architects who are just starting to look at this space. They hear energy infrastructure and they think that sounds complicated. That sounds like it requires engineering expertise I don't have, regulatory knowledge I don't have, or capital access I don't have. I hear that, and I want to be direct with you. 3 years ago, a lot of that concern would have been legitimate. The barrier to entry was real. The economics weren't there yet for private investors at the scale most of our community operates at. That has changed. The models I'm about to walk you through exist precisely because the infrastructure, the financing structures, and the incentive environment have matured to the point where this is no longer a specialty play. It is a wealth architecture decision, and you can make it with the same analytical framework you'd apply to any other hard asset. Now let's talk about where the real opportunity lives in 2026. There are specific models within the localized energy sector that are already proving their economics, and there are others that are still burning through capital looking for a business model. Your job as the architect is to know the difference. The first model I want to highlight is the islanded microgrid. An islanded microgrid is a power generation and distribution system that can operate completely independently from the main utility grid. It has its own generation sources, typically a hybrid of solar, battery storage, and a dispatchable backup like a natural gas or hydrogen generator. And it can disconnect from the grid entirely during outages or price spikes. The key word is islanded. It stands alone. When the surrounding infrastructure fails, it keeps operating. What's happened in 2025 and 2026 is that municipal governments and commercial districts that experience repeated outages are now actively seeking arrangements with private microgrid operators. They don't have the capital or the timeline to upgrade their own infrastructure, so they are entering power purchase agreements with private operators who built islanded microgrids on adjacent property and can sell stable, reliable kilowatt hours at a fixed rate. That's a private toll road for electrons. And just like physical infrastructure, whoever builds it first and builds it right owns the relationship for decades. The second model is what I'd call distributed storage arbitrage. Utility-scale battery installations and increasingly aggregated residential battery systems are now capable of performing a function called grid arbitrage. You charge the batteries when electricity prices are at their lowest, typically overnight or during periods of high renewable generation and low demand. You discharge, either for your own use or to sell back to the grid when prices spike. In real-time pricing markets, those spreads can be substantial, and the asset itself appreciates as grid stress increases because the value of dispatchable stored energy rises with every outage event. The third model is real estate generating power. This is the convergence of real estate investment and energy infrastructure, and it is the model I believe represents the clearest opportunity for the architects watching this right now. It's not complicated. You acquire or develop properties, whether residential, commercial, or industrial, that have sufficient roof area, land area, or structural capacity to host significant solar and battery installations. You build that infrastructure in, your operating costs drop dramatically because you're generating your own power. Your asset value increases because buyers and tenants in 2026 understand that energy independence is not a luxury feature, it's a fundamental risk management property. And in most jurisdictions in North America and Europe, you are now eligible for a layered set of incentives that dramatically accelerate your return on that infrastructure investment. The investment tax credit in the United States currently allows you to write off a substantial percentage of the cost of qualifying solar and battery storage installations in the year of installation. The MAC RES depreciation schedule allows accelerated depreciation on energy assets. Certain states have added their own credits on top of federal incentives. And for properties inside designated clean energy zones, there are additional grant structures that have barely been tapped by private investors because most of them are still looking at energy through a consumer lens rather than an ownership lens. The regulatory moat here is real. The jurisdictions that enacted these incentive structures did so with long phase-out timelines, some extending well into the 2030s. The entities that capitalize on those windows in the next 18 to 36 months will lock in economics that will not be available to anyone entering the market later. This is not speculative. This is how infrastructure investment has worked in every prior cycle. The first movers who build during the incentive window retain cost advantages that late movers cannot close. Here is what I want you to sit with for a moment. The investor who waits 2 years to evaluate this doesn't just mess a tax credit. They enter the market when the favorable interconnection agreements are already claimed, when the properties with optimal solar profiles are already under development by people who moved earlier, when the power purchase agreement terms have tightened because municipal demand for private operators has been partially met. The window is not theoretical, it is closing measurably quarter by quarter. That is not a sales pitch. That is the documented pattern of every prior infrastructure build-out cycle, from fiber broadband to natural gas distribution to commercial solar at scale. The architect who understands this doesn't panic. The architect calculates. Now let's bring this forward to the 2030 projection, because part of what we do at WealthForge is not just describe what's happening now. We build the mental model of where this trajectory is heading, so you can position ahead of the curve rather than behind it. The macro thesis is straightforward. Energy independence is going to become a socioeconomic sorting mechanism. Here's what I mean. Today, the ability to operate independently of the municipal grid is a premium feature. It adds value to a property. It's a competitive advantage for a business. It's a differentiator. By 2030, based on the trajectory of grid degradation, AI, compute expansion, and climate-driven stress events, energy independence is going to be the baseline expectation for any high-functioning commercial or residential property in a major metropolitan area.
The question will no longer be, does this property have energy independence? The question will be, why doesn't it? The properties, businesses, and individuals who made the infrastructure investment in 2025 and 2026 will be sitting on assets that have appreciated not just in market value, but in functional utility, because the world around them will be increasingly unreliable, and they will be increasingly not. That asymmetry compounds over time. The gap between grid-dependent entities and energy-sovereign entities will widen with every stress event, every rate increase, every rolling outage. And there's a broader social dimension to this that I want to name directly because I think it's underappreciated in most financial discussions. Access to reliable energy is access to economic participation. If your home goes dark and you can't run your home office, you lose income. If your business loses power for 4 hours during peak operating time, you lose revenue you will never recover. If your data-dependent investment portfolio requires continuous uptime to monitor and execute and the power goes out, you are exposed in a way that no hedge covers. Energy sovereignty is increasingly the prerequisite for all other forms of financial sovereignty. The architects who understand this in 2026 are not waiting for a consensus signal. They are not looking to institutional portfolio managers to validate this thesis. They are doing what architects do. They are looking at the landscape, seeing where the structural vulnerabilities are, and building the infrastructure that protects their position regardless of what the market does next. So let me be direct about what immediate action looks like. Step 1. Audit your current energy exposure. Walk through every asset you own, every property, every business location, every data infrastructure, and ask the question, what happens to this asset if reliable power disappears for 72 hours? Not forever, not catastrophically, just 72 hours of intermittent, unreliable supply. If the answer to that question is significant disruption or material financial loss, you have a structural vulnerability that needs to be addressed before it becomes a crisis. Step 2. Evaluate the economics of energy infrastructure in your current asset base. For every property you own, run the numbers on solar plus battery storage. Not because renewable energy is ideologically attractive, because the economics are compelling. When you factor in current incentive structures, the reduction in operating costs, the increase in asset value, and the optionality of grid arbitrage revenue, the return profile on properly designed energy infrastructure in the current environment is stronger than most conventional real estate value-add plays. Step 3. Look at microgrid investment vehicles and private energy infrastructure funds. There is now a maturing market of private equity structures built around exactly the microgrid and distributed energy models I've described. These are not early-stage venture bets. These are infrastructure plays with contracted revenue streams and long-term power purchase agreements providing cash flow visibility. If direct asset ownership isn't accessible at your current capital level, these vehicles can give you exposure to the structural trend without the operational burden. Step 4. Engage with the regulatory landscape in your jurisdiction now. The incentive window I mentioned is real and it is time-limited. The architects who capture these economics are the ones who do the work of understanding the specific structures available in their region: federal credits, state credits, utility interconnection agreements, clean energy zone designations before those windows close. The underlying message is consistent with everything we do here. You are not a passive participant in the systems that govern your financial life. You are an architect. And architects don't wait for the grid to fail before they think about what powers their operation. The centralized systems are straining. That is not a disaster for the architects. That is the market condition that makes the moat worth building. We don't follow the market. We designed Moat. The architects who move in 2026 will look back at this moment as the year the thesis became undeniable, and they were early enough to act on it before the rest of the world caught up. Now, before I close, I want to hear from you, and I mean that specifically. The community debate on this one is real, and your ground-level intelligence is something I genuinely cannot replicate from research alone. Here's my question for the comments. Have you started seeing local outages in your city? And more importantly, what's your current backup plan, or what are you building toward? Tell me your city and your energy strategy below.
There are architects in this community who are already running islanded systems, already generating income from grid arbitrage, already building the moat. If that's you, I want to hear what you've built and what's working. And if you're earlier in the process and you're trying to figure out where to start, post your question below and let's work through it together. This community is not a comment section. It's a strategic network. Use it like one. If today's framework resonated with you, if this connected dots that needed to be connected, hit subscribe and share this video with one person in your network who is still thinking about energy as a monthly bill rather than a structural asset. One conversation can change a positioning decision that changes a decade of outcomes. And if you want to go further right now, our next video breaks down the private family banking structure that gives you the capital vehicle to actually fund these infrastructure investments without touching your liquid reserves. The mechanics are counterintuitive, and the architects who understand them have a capital deployment advantage that most investors never discover. That video is queued up and ready for you. Stay sovereign. Keep building. I'm Dr. Ben. This is WealthForge, and the moat doesn't build itself.